Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. At present, the Australian dollar continues to hold to a somewhat bearish short-term assessment after experiencing a firm rejection from that topside level of 69 cents, while its rival, the greenback or the US dollar index, has slowly clawed its way higher and sits around 99.50 after rebounding from 99.25. The release of the Reserve Bank of Australia's RBA July Monetary Policy Meeting Minutes, published early Tuesday, suggests policymakers' readiness for an August rate hike if needed, after the board agreed some further tightening might be required, adding that they would reconsider at August to see whether a rate hike is warranted. Meanwhile, overall, traders were relieved after last week's data showed there is some light at the end of the tunnel to the US Federal Reserve's tightening cycle and hopes that the US inflation will continue to cool. That is enough to see the rate hikes possibly be put on hold after the meeting from the 26th of July, which expects one more hike of 25 basis points. Looking at the technicals, we are seeing a somewhat pullback, but the market is still respecting the area around 67.80, where I feel the challenge may be taken. But the technicals have not quite broken down, so still overall, let's see how we play out into today's session, with the resistance in minor at 68.45. The euro continues to push higher and now looks towards its key level of 112.40.60. A break there would give further scope to the upside and maybe see further pressure on the downside for the dollar, and that is see a rise up towards 113 to about 113.65. But as I mentioned, the dollar did rebound and we are extremely overbought, so it does warrant a pullback or a rejection from 112.40.60 and look down towards 111.75 to 111.35. The dollar yen took the challenge to the upside but didn't quite make the confirmation to the break of 139.35, and from the rejection has now put a mixed play into today's price action. Nevertheless, the market may take another challenge towards that top side, and if we do break 139.35, that would see a further indication to the bull case and confirm the engulfing candle, and therefore put a rise up towards 140 to about 140.65.75. But do take a little bit of caution due to the last 24-hour rejection, as the market still is vulnerable to a break of 137.15.25. So it is a bit of a tug of war at the moment, and let's see which comes out. I'm in favour of seeing the market break high, but let's see after overnight's rejection from that key level of 139.35. All eyes will be looking towards the UK inflation data, and therefore could see some direction in terms of a bullish case if the market does start pricing in a 50 basis point rate hike due to the inflation being extremely high, around 8.7 previously with a forecast of 8.2%. In light of that, dips are likely to be shallow and maybe finding support around 130.30. Looking at gold, the market presently is attempting to try and break higher, but there's still that key level which is seen at 1,964 to 66. If so, then that would give further scope up towards 1,976 to 77, but it all depends on this week's data, which is the US retail sales for June. And if so, could actually see the dollar rebound and see the gold drop back to 1,946 and reassess from there. Wrapping up with oil, the break of the trend has now given us a somewhat mixed outlook, but we've got a slight inverted hammer that could actually suggest that there could be a false break. The reason behind that is a close above $74 a barrel in New York tomorrow would give further scope up towards 75 to 77 or $78 a barrel. But a close under 74 would reinstate the downside and negate the top side and look towards a region of 71, 70, 80. Well, that's a wrap. Thank you very much for joining me. As always, look out for the interest rate report, and I hope you enjoy the rest of the day.